So we're here today with Dean Adler, CEO and co-founder of Lubert Adler Partners. Dean, thank you for talking with us.
Thank you, Jesse.
As a CEO of a large private equity fund, you have a great sense of what real estate investors are looking for. So where is the investor appetite for risk right now, and how's it evolved over the past year, and in particular since November 8th?
Terrific. So before we get to November 8th, which is a short-term issue, I think you actually have to step back and say, how do real estate investors invest over a cycle? So let's think of real estate cycles. Basically, they occur every 10 years. 81, 82, you had a recession. 91, 92, the RTC years. 2001, you had the whole tech bubble. Those were all relatively what called mild recessions. 2008, the Great Recession. So now you're between 2009 and 2017, the next 8, 9. So you said, we're in the what I'll call the later stage. I think as an investor, you got to take these 10-year periods, and you have to have certain fundamental constants as to what your investment philosophy is, but you also have to have the need to adjust. So let's take our 10 years between 2010 to 20. 2010, the first 3 years, 2010 to 13, I call those years the perfect investing period. Why is that? Values are down, no new supply, interest rates are going down, and not a lot of competition of capital because there's no debt. When you look at it, the first 3 years of any cycle, if you can invest during that and then hang out for 7 years, you have the best track record anywhere, okay? Mm-hmm. And so in those periods, you go buy distressed debt, okay, or you buy things that existing assets that are cheap and hopefully renovate or upgrade them a little. And I call it that first period, buy by the pound, and then maybe improve it. That's your mantra. The middle stage is 2014 to 16. And we're going to call that rehab or value add the product, and they will come. So this is a period where the distressed debt's no longer around. So you have to be a real estate person. You could buy a property, renovate, reposition, make some changes. You can even get into new development because there's not a lot of supply yet. And so there's premium for real estate executors. And that is what I'll call the middle stage on how you should invest your capital. Now we're in the later stage, 2017 to 2020. Mm-hmm. And your question was, what should you look for? I think this is a period where the mantra is safety, security, selectivity, and because this is a time where you want to be more cautious, protect your downside. The execution, you want to be more simpler. The big adaptive reuse of a job that takes 3 years, risky because in 3 years, where are we? So the time to upgrade and renovate should be shorter. Boy, so you want to make the time to stabilization shorter. You move up the capital structure to preferred equity, if you can. There's a lot of groups that are doing lending because from the valuation standpoint. So those are, you're staying away from the new development in this period. You're staying away from the big, massive adaptive reuse. Simplicity, safety, security really becomes your mantra. And then the last piece is you want to be ready to reload. Because, maybe you don't end up with the depression of 2008, but maybe you go back to a recession. And are you ready? If the thesis is, hey, 2 or 3 years out of every 10 is the time you should load up the truck, you want to get your cash war chest in place. You want to get your research done where the most oversupply may be versus demand. If interest rates move up and you have a little recession, you want to be ready. And if you wait till 2019 or 20 to raise your capital for that, the truth is when you go to investors then, they're getting hit again. They don't want to write the check. So the key is how do you get yourself in the position at the end of this stage to really capitalize on the next period.
So do you see investors, actually employing that restraint? on the market?
I think the investors are recognizing they should be more restrained. This is not a time to put all the chips on the table. I mean, the positive of the real estate industry is, though, when you look at the alternatives, okay, first you say, God, there's a little riskier in real estate. I'm a little concerned about these things. But then when you look at the alternatives, real estate still looks attractive.
Yeah.
So you still get the allocations there. And then you hear about what they call core investing. Let's go buy something that's already polished and clean, a trophy asset that's stabilized. The issue, both the opportunity and the issue. The opportunity is if you could buy a core asset and lock in 10-year money and really own it for 10 years, that spread between the going-in yield, which you can't get in the gateway markets, but you can in the other, and the interest rates is a positive element. But that's only if what we call you do long-term spread investing. Okay? The risk you take is if you think you want to get on 3, 4, 5 years, that's a big risk. Because in 3, 4, 5 years, if you're paying 4.5 cap rate today or 5 cap rate, that's 20 times cash flow. If interest rates go up in the next few years and supply goes up, you could be underwater buying stabilized assets. So if you're going to do the stabilized asset spread investing approach, you got to say to yourselves, I got to do it long enough to burn off what I'll call the excess purchase price you're paying up front. I need to own them long enough to get through year 3 where there could be potentially raising interest rates and higher supply. But over a 10-year period, I'm owning a better asset. I've locked in my debt, which could be 60% of the whole value. I have a positive spread. Maybe I have leases to take me through this period. And so to me, that's the only way you should look at doing the stabilized core assets if you're prepared to go long and match it with a debt security that has equal duration.
So in terms of these more conservative investments, let's say a long-term locked-in spread investments, what returns are investors looking for there?
So look, I mean, if you're looking at just the long term, they're probably looking at 8-9% overall rate of return and then levering about 50%, which is really not our area. You know, our area is trying to get more return where you take a little risk. But the key to the risk is you got to really keep asking yourself, how are we buying, managing, and protecting our assets in light of a potential downturn? And that is, for an investor today, you got to focus on the downside components. And our sort of fundamental constants of downside components are, number one, we want to own rental assets versus non-rental. What do I mean by rental? Multifamily, retail, maybe some limited service hospitality, where if we could get an income stream within 18 months, because if we could get 2/3 of our return from current income and not wait for the back, that's a good risk return. The current income gives us a buffer. And in 2008, those assets that had a current yield, they went down, but then they recovered. Versus a non-rental asset, land, large-scale development, resorts, for-sale condominium, there your returns are all back-weighted. And by the way, and most of those assets are non-discretionary. I mean, are discretionary, meaning people don't have to have a condo. They don't have to go to a resort. Versus the rental assets, you need a place to live, you need a place to shop, you need a place to work. So, and in 2008, the non-rental assets had no floor. So number one, the type of asset you choose is really important now. Number two, do you have a cost basis advantage? Are you buying something and renovating it so our all-in cost is less than its competition? And if it is, then you could always drop your rents and still have some downside. Number three, should you go into the preferred equity, move up the capital stack? Number four, if you are going to do leases other than multifamily or hotels, can I get some duration? Can I do some long-term leases? By the way, if you want to play the retail game, you don't want to buy a center that's halfway where a lot of the tenants are rolling in 5 years. Those tenants are going to be around. The way to do the retail game is try to control parcels of ground. Don't buy them yet. And if you can lease them to long-term credit, 15-year grocery leases or 20-year grocery leases, or big boxes 10 to 15 years, and you have investment-grade tenancy, that's a good retail strategy. If you're going to buy a power center that they're 10-year leases and you're 5 years into it, that's just Russian roulette. Yeah. Because unless the sales are so high you're just rolling the dice of people, what people, whether they're going to renew or not, and at what rate they're going to renew. So, I mean, the bottom line to it is in this part of the cycle, it's not just business as usual. You need to have some fundamental constants in how you invest. And number two, you got to shift for the safety, security, and simplicity mantra of this period.
Okay, so in that respect, are there any sort of asset classes or geographies that investors should be avoiding at the moment?
Well, interesting, it's probably some of the more attractive asset classes and markets are the ones that are going to get mushy. So number one, let's talk about some of the urban areas. Everyone thought if you're in a downtown area, there are high barriers to entry. What we're learning is, because there's no land, right? Let's go to the suburbs, there's land. What we're learning is, actually, a lot of downtown areas have the lowest barrier to entry. Because once you get high enough rents that you can afford to build, think about a 40-story tower. If you're talking about a 40-story tower and every floor is a half an acre, 22,000 square feet, that's just 20 acres. You get 30 of those going or 40 of those going in a marketplace, and guess what? That's called oversupply. So, downtown Chicago for apartments, Boston, Philadelphia, you have a lot of, new apartments being built in what you thought was high barrier to entry markets, but may not be, okay? You think of New York City, it's the best market of them all, over time, and in the hotel side, you have 13,000 hotel rooms opening this year. What's that going to mean? I mean, they won't blow up, but you're going to have a few years of softness.
Yeah.
You go to what I'll call the sexy growth markets, Austin, Nashville, Charlotte, Raleigh, Atlanta, Tampa. Those have all enjoyed excellent growth, but now you had a lot of multifamily, a lot of limited service hotels. And so I like those markets. I just don't like buying there now because you're going to have a good 2-year period where it's going to be very mushy, soft, concessions. But perhaps I talked about earlier, with the war chest and making your research, perhaps those are the markets you want to do the research, because when it does get soft 18 months from now, you may have the opportunity to either buy or recap existing partnerships at such a time. And I'd like to buy those type of assets, what I call the oversupplied assets, in the growth markets, because eventually they fill up, versus going in the middle of the Midwest, back to Cleveland or Detroit or Iowa or, areas that you may be able to buy right, but the question is, where's the demand coming from? And so I'd rather buy where there's going to be demand going forward, but I want to wait until it gets soft from the oversupply.
Okay, so are there any areas that you think are drawing any interest at the moment, or are most investors?
There's area. I mean, industrial's been a very hot area
Yeah.
because as things move into e-commerce and distribution, it's been a very strong market to get into, and the whole infrastructure, industrial distribution's been very, very good. I think workforce housing, apartment housing is very good. I mean, people need a place to live. Not everyone's rushing downtown to live in the modern luxury high-rises. And, especially if this workforce housing is in good school districts. I think in certain areas, urban retail, first floor retail is very good because you have the density backed in, and there you do have limited competition. You got to be in the main streets, and you got to be in the first floor. See, in the apartment buildings, they're from floors 2 through 40. A lot of competition. There's only one first floor for the main street retail. We like, pre-leasing grocery stores a lot. I mean, that's a good business for us. And anything that you could take an asset and reposition it. There may be a C asset in an A location. If you can go in and upgrade, renovate, and use real estate execution skills, that is really what we focus on. But the key is you got to be more selective today. There are value-add opportunities, but just fewer of them. And if you want to stay in the margin business of having high margins, you got to recognize that this is the period we're in, and you got to selectively pick them off. But this is not a time to say, let's go buy it by the pound or buy big bulks just for the sake of owning real estate. I think if you do that, you can be very disappointed in 3 years.
Great. Well, thank you so much for taking the time.
Thank you.
This has been great.
Appreciate it. Thank you.